Good morning. It is Wednesday, June 10th, 2026. This is your deep dive daily briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic and military posturing surrounding the Middle East conflict has reached a highly delicate phase following the formal deployment of Operation Desert Sentinel. Overnight, United States naval and air units carried out a third consecutive wave of precision strikes against underground military infrastructure and mobile anti-ship missile launchers in southern Iran. The Pentagon confirmed that while the offensive has significantly degraded active coastal radar networks, the tactical environment remains exceptionally volatile. In a televised address, the Iranian leadership stated that any continued Western intervention will result in an asymmetrical expansion of the conflict theater, warning that regional commercial assets and external energy infrastructure are now within active striking range. This uncompromising stance has frozen all back-channel diplomatic communications via Pakistani mediators, leaving international observers to monitor a highly precarious, day-to-day escalatory cycle that threatens to permanently rewrite maritime security.
Transitioning from the active theater of war to the broader global economy, the immediate loss of stable transit routes through the Persian Gulf is forcing a severe downward revision of international manufacturing capabilities. A joint memorandum issued by the World Bank and the Organization for Economic Cooperation and Development warns that the systemic material deficit has begun to trigger structural pauses across high-value industrial sectors. With raw petrochemical inputs and oil-derived naphtha inventories reaching critically low levels in Western Europe and East Asia, multinational industrial conglomerates are implementing mandatory rolling closures of manufacturing facilities. Economists observe that this supply-side shock is aggressively feeding a stagflationary spiral, where a sharp contraction in actual industrial output is paired with double-digit energy inflation across major consumer markets, severely compromising the baseline economic growth targets for the fiscal year.
In the realm of finance, this severe macroeconomic disruption has completely fractured traditional capital market layouts, accelerating a massive flight to safety across international capital networks. World crude benchmarks have maintained an exceptional upward trajectory, with Brent oil holding firmly above $124 per barrel as institutional investors fully price in a protracted blockade of the world's most vital energy choke point. On Wall Street, equity indices remain under severe liquidation pressure, with bond managers reacting aggressively to a sharp increase in sovereign yields as fears of unanchored inflation expectations rise. This capital market volatility is accelerating an institutional migration away from traditional dollar-denominated assets, verifying reports from European financial authorities that global wealth managers are rapidly redirecting long-term portfolios toward physical gold and alternative sovereign debt instruments to insulate corporate balances from a highly volatile economic ecosystem.
Turning our attention to the technology sector, these physical energy constraints and credit market pressures are forcing a fundamental reassessment of infrastructure expansion models for advanced computing. Hyperscalers are confronting a critical utility bottleneck, as the unrelenting power demand required for generative artificial intelligence workloads collides with highly vulnerable and overextended public grids. In a major corporate realignment, leading technology conglomerates have suspended planned data center developments in primary European hubs, instead redirecting tens of billions of dollars in capital expenditure toward localized, self-sustaining modular nuclear power solutions on the United States East Coast. This strategic pivot marks a new operational blueprint where technological leadership is no longer determined solely by software or algorithmic refinement, but by the physical and geographical security of vertically integrated energy networks capable of sustaining high-density computing independent of global raw material disruptions.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, which are now finalizing permanent adjustments to operate within a capacity-constrained global trading system. Maritime intelligence data confirms that the global container fleet is operating at an absolute maximum deployment baseline, with available idle capacity hovering at a record low of 0.3%. Shipping lines have entirely codified the Cape of Good Hope route as their standard operational default for all Asia to Europe trade lanes through the third quarter, completely moving away from the low-cost frameworks of the previous decade. Logistics professionals report that this extended routing has completely absorbed vessel supply, pushing maritime transport insurance premiums to prohibitive levels and forcing global enterprises to accept high-cost regional inventory buffers as a permanent cost baseline to insulate international trade from state-level maritime choke point interventions.
In summary, the global landscape is defined by the continuation of U.S. airstrikes under Operation Desert Sentinel amid Iranian threats of asymmetrical expansion, occurring as the World Bank warns of a deep manufacturing drag from critical resource shortages. Financial networks are navigating a persistent surge in crude oil above $124 and Wall Street liquidations, while the technology sector redirects billions toward self-sustaining nuclear infrastructure for AI, and the global logistics industry finalizes its transition to a high-cost, capacity-constrained maritime baseline. Based on the current trajectory, I predict that the ongoing implementation of Operation Desert Sentinel will permanently cement a high-cost economic environment for the remainder of 2026. By shifting from diplomatic negotiations to a direct and sustained air campaign, the international community has effectively entered a period of protracted containment. The physical reality of clearing unmapped sea mines under active combat conditions means that maritime freight rates and transport insurance premiums will remain at prohibitive levels through the winter. Consequently, the structural deficit in industrial raw materials will deepen, making it mathematically improbable for the Federal Reserve to justify any easing of monetary policy, and forcing corporate leaders to permanently accept that secure, low-cost globalized commerce has officially been replaced by a balkanized trading order centered on regional resilience.